What does it take to be financially healthy? For lots of people, the answer is investing. Because when you invest your money, you're not just setting it aside for the future. You're also helping it grow. That's probably why 61% of Americans have at least some money invested in the stock market. But I get it. There's a lot of types of investments. That's why I'm here to lay them all out to help you decide which is the best way to invest money for you. Before deciding the best way to invest money, you need to ask yourself 2 questions. What's my financial situation? And what are my financial goals? These questions will help you decide your risk tolerance. If you've got plenty of savings and you're hoping to significantly grow your wealth, then a high-risk, high-reward investment could be in order. But if you've only got a small amount of savings that you can't afford to lose, then you need to choose something safer. With that in mind, here are some of the best investment opportunities available. First up, a high-yield savings account, also known as an HYSA. High-yield savings accounts are the best way to invest money if you want to completely eliminate risk while maintaining access to your funds. An HYSA is a savings account with, surprise, a higher than normal interest rate, and most are FDIC insured. That means the federal government guarantees the first $250,000 in the account. In other words, you literally can't lose your money. HYSAs are also designed for easy access. You should be able to transfer funds from your HYSA to a checking account with just a few clicks. One great example of a HYSA is the Upgrade Premier Savings Account. Rates can change, but as of publishing this video, it offers over a 5% annual percentage yield, meaning that's how much your money would grow in a year. And that's not the only HYSA pushing 5% right now. CIT Bank Platinum Savings offers it too on balances of $5,000 and over. And there's way more options than that with extra high yields. I'll link some of my fave accounts below. And to make sure you're as well informed as you can be, let's walk through the pros and cons. So there's typically no risk due to FDIC insurance, which is great, but returns are lower than what you can get with riskier investments. You can also access your money at any time, but if interest rates fall nationwide, said money will start earning less. The best part though? You can typically earn more than 5% annual percentage yield, and there's nothing shabby about that. So yeah, HYSAs are great, but if you want to push the limits of your returns while remaining risk-free, I have 2 letters for you: CD. A CD, also known as a certificate of deposit, is the best way to invest money safely if you can afford to lose immediate access to your money. With a CD, you give your money to a bank or credit union for an agreed-upon amount of time. You're meant to leave the money untouched until this term is over. If you withdraw money early, you'll most likely have to pay a penalty. So why get a CD when you could just put your money in a savings account and maintain constant access? There are 2 main reasons to go for a CD. The interest rates are often higher than they are for savings accounts. And secondly, the interest rates are fixed, which means they don't change in response to market conditions. Most CDs are FDIC insured, so unless you deposit more than $250,000, your money will be safe. Banks often offer a wide variety of CDs, and each term length will have its own APY. There are also jumbo CDs, which have large minimum deposits but tend to offer even higher returns. Do you have enough in savings to deposit a few $1,000s or more? If so, check out the list of the best jumbo CDs below. Now, let's take a look at the pro-con chart and start with the negative. You'll lose access to your money for the duration of the term unless you pay a hefty penalty. And having your money trapped means you could miss out on better investment opportunities. But on the flip side, the interest rates are often high. Most are FDIC insured, and the rates are fixed so you're protected from a general drop in rates. Intrigued by the better investment opportunities mentioned? Let's get into those. Say hello to exchange-traded funds, also known as ETFs. An exchange-traded fund allows you to buy an assortment of stocks all at once, and it's the best way to invest money in the stock market while minimizing risk. It's common for an ETF to track a particular stock market index like the S&P 500. That means your gains and losses will mirror the fate of the stocks that make up the index. The great thing about an ETF is that it's a diversified investment. You're not betting on the success of a single business, but on the collective fate of multiple companies. That said, the success of an ETF investment is linked to the stock market. Losing money is a real possibility, but the stock market has been steadily growing in value for decades, despite the dips and crashes that create all the headlines. That's why an ETF is usually best for long-term investors. And unlike mutual funds, ETFs can be bought and sold all day. That increases flexibility for investors. You can invest in an ETF through digital investment platforms, like Stash. This finance app will create your diversified portfolio for you. Acorns. This platform promotes healthy habits with an automatic savings feature. Magnify. With an AI assistant, this app will put the power of technology behind your investments. M1 Finance. This is a classic brokerage account, perfect for managing your own transactions. All are linked below, and, of course, ETFs come with their own set of pros and cons. Your investment is diversified, but that means less chance of a fat return, and you may get charged a maintenance fee. However, you can trade them throughout the day given the stock market is open, and they're often commission-free. Now, let's kick it up a notch. Enter index funds. An index fund is similar to an ETF in that it allows you to invest in a group of stocks, called an index, all at once. This gives the investment more diversity, which is helpful for minimizing risk. Massive gains, especially in the short term, are unlikely with an index fund. This isn't an attempt to beat the market, but an investment that tracks the general market's progress. That's why an index fund is the best way to invest money for young investors. Sure, there might be some dips in the market, but if you're committed to playing the long game, the market is likely to go up eventually. Investing in index funds is easy if you use an online brokerage platform. Magnify is one option, and it has the added benefit of providing AI-generated advice. There's also HYSAs, which lets you choose between managed portfolios and self-directed trading. I'll link them both below. In the meantime, let's weigh the pros and cons. Diversification helps to minimize risk. You'll benefit from the stock market's long-term growth, and management fees tend to be low. But on the con side, some platforms have a minimum investment requirement, and you're again not as likely to earn the fat returns that may come with individual stocks. Though, you risk fat losses in that boat too. So how much of a con is it really? Did someone say individual stocks? Yeah, I know you heard me hint it on the con list, so let's dive in. Buying individual stocks is the best way to invest money if you want to take a shot at earning truly impressive returns. It's risky, but it also gives you a genuine chance to get rich quick. When you buy stock, you're buying shares of a company. That means your investment is tied to the fate of that particular business. If things go well, you could make a pretty penny. If things go poorly, you could lose it all. High risk, high reward. That's the phrase to remember. So, should you invest your emergency savings in the stock market? No, that's basically just gambling. But if you've got some money that you can afford to risk, meaning you have other money stashed in safer investments, then buying stocks can be a great way to diversify your portfolio and give yourself a chance of seriously growing your wealth. And thanks to online platforms, investing in stocks is easier than ever before. Here are some platforms that you can use for investing. Robinhood. This platform has become famous for making it simple to buy stocks online. Fierce. This app-based service offers both stock trading and crypto trading. Public. From stocks to artwork, this platform can help you invest in practically anything. SoFi Invest. This online bank offers stock trading as one of its many financial services. I'll link them all below. You can also check out my video fully dedicated to investing in stocks. And you know what time it is? Pro-con list. Pros. You can earn massive returns. Use stocks to increase your portfolio's potential upside. And it's so easy to buy stocks online with modern technology. Cons. There's of course a risk of losing your money, and success often requires extensive research. Ready to kick your diversification up a bit? Say hello to real estate investing. To invest in real estate basically means to buy properties. And it's the best way to invest money if you really want your portfolio to be diverse. With traditional real estate investing, you'd start by purchasing a property. This could be a house, an apartment building, a business space, or even a plot of empty land. From there are 2 ways to potentially make money. Rent this space to tenants and collect monthly rental payments. Watch the property increase in value. Thanks to digital investment platforms, though, you can invest in just a portion of a real estate deal, making it easier to get involved with smaller amounts of money. You'll still get the benefit of diversifying your portfolio, but you won't take on the risk of owning an entire property yourself. Talk about a win-win. Some awesome real estate platforms are Fundrise. This platform specializes in alternative investments, including real estate and venture capital. Arc 7, if you want to invest in rental homes. This platform makes it easy. And Ground Floor, by offering fractionalized investments, this platform makes it simple to enter the real estate game. Do you like the idea of getting creative with your money? I'll link a list of the best alternative investments. And of course, let's look at the pros and cons. The returns can be big, but you'll of course lose money if property value goes down. Rentals produce a regular source of income, but you can't access money that's tied up in real estate property. That makes them a good long-term investment. But managing a rental can take a lot of time and effort if you don't outsource, which will hit your bottom line. Now, I can't talk about investing nowadays without mentioning crypto. Cryptocurrencies like Bitcoin and Ethereum are alternative forms of money that exist in the digital world. While cryptocurrencies still aren't used for most day-to-day transactions, they've become popular for investors looking to take a chance and diversify their portfolios. Dogecoin, anyone? Kidding. Although it did have its moment, which is a great call-out, cryptocurrency markets tend to be especially volatile. What does that mean for investors? Extremely high risk, but also extremely high rewards. So crypto probably isn't the best way to invest money that you'll need to use in the next few years. But if you have some additional savings and you want to give yourself a chance of hitting it big, then sure, it might be worth considering. You can buy crypto with an investment platform like Public or go through an online bank like SoFi Invest. So let's recap. Price volatility can produce massive gains, but also leaves you vulnerable to massive losses. You can buy and sell any time of the day, unlike the stock market, but the markets are crazy hard to predict. And lastly, it's nice how the infrastructure is continually growing. Wanting something more tried and true? The name's bond. Just bonds. Basic humor aside, bonds are basically miniature loans that you make to a company or the government. In exchange for buying the bond, you're entitled to earn interest. Since the interest rate doesn't change, you know how much you'll earn. This makes bonds the most common example of a fixed-rate security. Government bonds have the benefit of being almost completely risk-free. They also tend to increase in value whenever the stock market decreases, which is what makes them a stabilizing force in your larger investment portfolio. There are two main types of bonds: government bonds, issued by states, municipalities, or even the federal government, which allow you to avoid risk, and corporate bonds, issued by companies, which makes these bonds much riskier. So if your goal is stability, then government bonds are the way to go. You can buy bonds through pretty much any brokerage service. If you want to maximize convenience, I'd recommend using Stash or Robinhood. They're both app-based platforms, making it easy to manage your finances on the go. I'll link them below. Now, let's do one final pro/con list. Pro, you'll earn at a fixed rate. But con, there's no chance of long returns. While bonds are essentially risk-free, you likely need riskier investments too. With that though, they're great at balancing a diversified portfolio. Ready to diversify the heck out of your portfolio? Me too! Let me know in the comments what investment you're trying out first and make sure to subscribe while you're at it. Happy investing!